People talk about decentralized finance like it is the future of money. No banks, no middlemen, instant transactions. It sounds powerful. But what does DeFi do and why are regulators, banks, and investors paying so much attention to it? Today, I will break down how DeFi works, what problems it tries to solve, and where it fits next to traditional finance. At its core, decentralized finance is a financial system built on public blockchains. Instead of banks holding your money and approving your transfers, DeFi uses smart contracts. These are pieces of code that hold your assets, process transactions, and follow rules on their own. No banker, no office, no opening hours. DeFi grew because traditional finance can feel slow, expensive, and limited. Cross-border payments take days. Bank fees add up. Access depends on where you live and what documents you have. DeFi promised something different. Anyone with a phone and internet could lend, borrow, trade, or save. No permission needed, and everything settles on chain, which means you can check the records yourself. Nothing is hidden. So, what does DeFi let you do? You can lend your crypto and earn interest. You can borrow against your assets without speaking to anyone. You can trade on decentralized exchanges that run on code instead of a company. And you can use stablecoins to move digital dollars across borders in minutes. It tries to rebuild the financial system on open networks. The engine behind DeFi is the smart contract. Think of it as a digital agreement that executes itself. Users lock assets into the contract and the contract manages everything automatically. But there is no customer support. If the code breaks, the funds can be lost. Code replaces the middleman, which is both the strength and the risk. DeFi has real advantages. It is open to anyone, it is fast, it is transparent, since you can see all activity on the chain. And it forces financial services to compete globally, not just locally. If you look at stablecoins, especially in the emerging markets, people use them because they are faster and sometimes more stable than their local currency. That alone pushed DeFi adoption forward. And here is the honest side. DeFi comes with serious risks. Smart contract bugs can drain entire pools. Scams and rug pulls still happen. Platforms can collapse when collateral prices crash. There is no deposit insurance. And because everything is built in code, mistakes or attacks can move very fast. Regulators worry about consumer protection, obviously, money laundering, and financial stability. Some DeFi services act like banks, but without the safety framework that banks built over decades. DeFi will not replace banks or payment systems, at least not fully, but it is influencing them. Banks are exploring tokenization. Central banks test digital currencies. Financial market infrastructures test distributed ledger technology. The future looks hybrid. Some services stay centralized for safety, others move to decentralized networks when automation and transparency matter. So, is decentralized finance the future of money? It is part of it. DeFi shows how finance could work when rules live in code, not in paperwork. But it also shows the weaknesses of a system with no built in safeguards. The most likely future is a blend of both worlds, where innovation and regulation grow side by side. If you enjoy videos that cut through the hype and make financial technology easy to understand, subscribe and tap the bell. And tell me in the comments, is DeFi a breakthrough or just a temporary experiment? See you all in my next video.